Welcome to the Norris Group's 13th annual I Survived Real Estate Gala. The Norris Group would like to thank the following platinum partners: Norada Real Estate Investments, San Diego Creative Investors Association, the Outspoken investor Tony Alvarez, Wilson Investment Properties, Think Realty Magazine, and Realty 411. We'd also like to thank our gold sponsors, Seven Figure Flipping, Inland Valley Association of Realtors, Keller Williams Corona, Keystone CPA Inc., Brisas Escrow, Leivas Tax Wealth Management, In a Day Development, NorCal REIA, NSDREI, Pasadena FIBI, Real Wealth Network, SoCal Cash Flow, Spinnaker Loans, and uDirect IRA.
Good evening, everybody. Welcome to the 13th annual I Survived Real Estate. My name is Aaron Norris, and I'd like to welcome you to this evening, and thank you for being here tonight. COVID has forced us to cancel our black tie event at the Nixon Library for the very first time, but we thought the content for this evening was even more important than ever. So important, we've split it into two nights. Last Friday, we had the California Residential Town Hall. We brought together experts and friends from all over the state to share local level of their expertise, as well as different things going on in the different markets, as well as the different categories like notes, flipping, realtor space, legislation, regulation coming up. It was really, really great. And then today we have the National and Commercial Town Hall. We purposely positioned this after the election, bringing together experts from all over the United States that also focus on different asset classes and strategies. Tonight, we learn with the uncertainty we're facing how they are feeling about 2021, shifts they are making, and possibly, depending on who becomes president, some additional shifts they might be making and what they see for the year ahead. I am thrilled to announce, as of today, we have crossed the $1 million mark.
Yay!
13 years later is very surreal. Thank you for helping us get here. All the sponsors over the years, for those of you who have done walks with us and raised money individually, it's been pretty cool. And typically we pay for the event, so 100% actually goes to charity. And tonight, this is online. There's no different. 100% of what we raise actually does go through Make-A-Wish. Make-A-Wish and St. Jude Children's Research Hospital are the recipients of all the funds. If you've been invited by one of our generous sponsors tonight and feel inspired to give, just visit isurviverealestate.com and visit the video page to learn more about how to do that. If you are enjoying this on Amazon Prime, YouTube, or any of the social media platforms that we produce this on later on, please do the same. isurviverealestate.com. First, take a stop at the sponsors and check out all this awesome support that we've had over the years and visit them, and then check out how to make a tax-deductible donation there. Tonight, we are just going to jump right into it. We did some of the more formal business last week, and so I am here. We're going to bring on the host for this evening, investor, builder, hard money lender with almost 40 years of experience. I get to call him Pops. Welcome, Bruce Norris. Yay!
Did you have to say 40 years?
Almost 40 years.
No. Yeah, it's good. Yeah. When it was kind of funny, you get your AAA card and it said something this year it never said. It's that thanks for 50 years of loyal customer. It's like, oh my God, I need to see that. I want to say something, Aaron. I want to thank you. You took the company to another level in 2005 when you joined it. And I remember the first time I taught a seminar with your touch on the document. And as people came in and they had their 400-page document that was full color, they opened it up and there were audible gasps. And it was the coolest thing. It was the greatest thing to teach off of. And this nonprofit, the event that we have, the I Survive, that was your brainchild. And that came from kind of your brainchild of a radio show. It allowed us to have credibility enough to say, would you come to this event? And remember the first event we had, I Survived, the audience, we did sell it out, but everyone was not sure what it was.
They were very confused. They were like, what is this?
Yeah, is this a seminar? Or
I have to dress up?
We're trying to, what? Yeah, it was like, and it became like our industry's ball. It's been so fun.
It's been really fun.
Thanks for dreaming that stuff up.
Yeah, and the Roni Awards and getting to honor, these lifelong mentors, not the gurus, but the mentors that behind the scenes make us all better. It's been an honor. It's been a really special event, and to keep it going is pretty stinking cool. And this year, I can't think of a more necessary time to talk about everything going on. So, ballots are still being counted as of today. We're recording this on the 6th of November. California results won't be declared until December 11th. We've got the Proposition 15, which was the split roll commercial taxes. The no's right now are winning at 51.8%. I have to be honest, I wasn't sure that was going to happen. So we'll see. Things can change. Proposition 19.
By the way, I'm very surprised that didn't pass.
I am
To me,
too.
that's a really big statement that it's not okay to tax other people's stuff, which I really was surprised at. I thought that would be a go-to. Oh my gosh, I don't own a commercial building, so yeah, let's tax him. I
Well,
just thought that was a very positive decision.
they did the 3 million mark too. So it just sounds like you're really positioning to really mess with the really rich people. $3 million, does that even buy you a starter home? I don't know, in LA, San Francisco.
But the fact that it didn't pass, that surprised me, and I'm happy about that.
Well, it can still change, but as of now, the no's are ahead. Proposition 19, that's the property tax rules that allow seniors, disabled, and disaster victims to transfer their primary tax base to a replacement property. I believe it's up to 3 times. And the trade-off was inherited homes, the process will change. So if you inherit a property, you'd have to move into it within the year to adopt the basis of that. So that was the trade-off, and that is winning, yes, at 51.4%. So I guess that would sort of do away with the proposition, is it 60 or 90, where people in some counties, just a handful, I think there's 10, that could move their basis. So that changes things up. And of course, Proposition 91, rent control. I feel at this point, it's a pretty safe no at 59.8%. So I saw some really interesting commercials across the board. Even affordable housing creators said that this was bad for the economy and that wasn't going to accomplish what people thought it would. So I was surprised to see such a high number. And this feels like we just did this 2 years ago, but it was no again. So they keep coming back for more.
But okay, well, let me ask this question because it's interesting. We had a legislative panel a year ago because it was an interesting thing. 2 years ago, we said no to rent control. We just said no to rent control again, but in the middle, we had rent control.
Yeah,
so
different process.
Well, that's just interesting. So, and that was why we had the legislative event, was to ask them, okay, how do laws get enacted? And are there options that are different during, let's say, a crisis? And that's kind of what we learned, is that, yeah, there can be different avenues of getting something done if you have to get it done.
So it looks like right now, real estate won for the California election. The state did not. The state cannot print money. Neither can counties and cities. And there are some pretty big budget gaps to plug. I guess the opposite play of that is Biden looks like he is slowly gaining traction, and that I don't know. What are your thoughts? Have you been following today sort of where things stand?
Aaron, I've actually avoided it. This is, I guess, my sincere hope, and I've kind of said this before. I just hope whoever ends up in office is able to encourage both sides somehow reach across the table and become more American than they are Democrat and Republican. I don't. It seems like a pie in the sky wish, but I hope at some point that spirit takes place, because we do have some serious issues that we have to deal with, and I hope I hope it's still capable. We're still capable of that.
I'm the guy, 75% glass full with chocolate shake. So I think we can get there, but man, we need a shift. A Biden presidency, when it comes to real estate, there was a great Housing Wire article. They're sort of pointing some things out. $15,000 tax credit for first-time home ownership, sharper regulatory for the CFPB. Being a lender that's regulated under that for some time, it's hard to imagine it getting any tougher. It's hard on small business. It's very onerous. And then, of course, revisiting the 1031 exchange. I know that's going to be some of the things that we talk about tonight as we talk to all of our experts.
Let me just bring up something, because I mean, I think this is important. So housing can participate, and you and I have talked about this. We brought it up on other shows. There is a very simple solution, and it's a nothing down loan to people to own their first home. And I know that's going to raise the hair on people's neck. Okay, so we always want to have affordable housing. LA County spent how many billions of dollars getting what?
$1.2 billion. They were hoping to create 10,000. They're on slate for 6,000 at an average cost of $530,000, with some as high as over 700,000 per unit.
And where did that money come from? That was real money.
Yeah,
we have affordable housing. It's called a 2% interest rate.
Mm-hmm.
And so what would happen in Florida if you said, okay, a nothing down home loan is possible for your first home, and you qualify like through a VA process to where you actually have some residual cash flow, and but down payment is not necessary. And the fear is this is going to create tons of foreclosures. Okay, we'll make a national foreclosure law just for this loan program, to where the goal is to get people to participate and they feel like they're part of the goodies. I know the first time I owned a home, it was a big deal to me. It really was. And so you could get maybe 5 to 10% more home ownership percentage to own a home. Nothing down, 2% mortgage rate. Are you going to have a failure rate? Yes. So let's deal with the foreclosures this way. And that's the biggest issue. If you had a glut of foreclosures going back that had to be sold at the typical way and interfered with the comps of the other inventory, yes, that could be bad. Let's say you had a 10% fail rate, but the way the foreclosure process was taken care of is the opening bid. 6 months after you stop making your payments, the opening bid was the late payments. The late payment bid is bid by another owner occupant first. They get first shot. The loan never goes back to the lender. Somebody else moves in the house. And I think society would feel like we had more participation, people that feel disenfranchised. Okay, all these guys are rich and they own stuff and I don't have a shot. Well, now you do. And that's one thing real estate could really offer with virtually no risk.
I'm going to throw some other ideas at you. Take the same concept, apply it to gentrification. That's a dirty word. Well, what if landlords tired of tenants' toilets and trash can work with a nonprofit and donate their house to a nonprofit and layer on this program, where consumers that were looking to maybe buy the house that they've been renting for a long time, they can end up participating in a program like Habitat for Humanity, fixing other houses, learning, getting the financial stuff that's at CFB be set up to do financial education of what home ownership can do. And you can have families investing in the same neighborhoods that they've rented for a long time, but gives some benefits for the landlord for doing it. A charitable donation, handing it to a nonprofit that knows how to fix things up and to somehow encompass that loan with the repairs, so the landlord doesn't have to fix it either. We just need some innovation. I think it's possible. I don't know why they won't do it. You want a really crazy idea? How about a loan program where you get to roll in your student education and refinance from a 7% rate into a home?
Absolutely. Absolutely. You know, what was interesting, Tom Wilson is going to be joining, he's going to do a presentation, but he's on the show right now. When we went back to speak to Fannie Mae, in private conversations, there was a lot of agreement on a lot of the things that we were suggesting, but it always came up that there was no way to get it.
Uh-oh. Dad, you cut out. Nope, you're not on. Well, that's always fun and exciting. But yeah, there was a lot of agreement behind the scenes, but politically, yes, it's just hard to get things through. And especially with two parties that just can't agree on anything and always want to be positioned to be the shining star, not always fun. Yes, Andy, technology is grand.
Can you hear me now?
I can.
Okay. Thank God.
Yeah.
I don't even know what I did to stop it, but anyway.
Anywho, well, yeah, you were saying that when you were back in Washington, D.C., the thought was, it should go through, but what was holding it up? Just politics, right?
What we were talking about getting investors more financing instead of having 10 loans, give us more loans. And it seemed like, okay, that's a great idea, but there's no way for us to be able to get it passed. And so that's kind of the same barrier that you have with a nothing down loan. There's this residual memory of what happened in 2006 and 7 standing in the way of something that could be really a good thing for society. And real estate could be a player in affordable housing without costing a dime. That's what's great. It's just there for who knows how long.
Well, you could always run for office. I'm just saying.
Let's go back. Let's get back in front of Fannie Mae or Congress or something.
Well, I don't have any more questions for you. We got this news of a 6.9 unemployment rate, which was a little bit of a surprise, way earlier than anybody else thought that we'd get to. I know that'll come up probably in a few presentations. How are you feeling about that number?
I think probably off air we talked about that. I think that just there's perhaps a lot of people that are not being counted. I'm all for the economy coming back booming, but again, it's just there's some businesses that I just know are going off at half speed or not even open yet. And maybe it's my experience in California because it's different. In Riverside, it's different than it is in Florida. Florida is quite a bit more open. So if you go to a restaurant, I mean, there's people inside, and it can be pretty packed. So it's a little bit different. So I'm by the way, I think it's an amazing thing that we've recovered to the extent that we have. Whether the 6.9 is exactly accurate, this is an economy that has an awful lot of resilience, and so I'm excited that it's improved to the extent that it has because. I mean, 6 months ago, we had Great Depression numbers. It was pretty scary.
Yeah. Well, with that, I'm going to hand it over to you to launch the night, and the stage is yours to introduce speakers. We're a little early, but that's okay.
Aaron, I actually thought you were going to do that.
Oh, that's
I'm sorry.
Fine. That's fine too.
Okay.
Well, Marco, surprise, you're up first. Marco Santarelli. We met at Think Realty. Does a lot of the can you grab the screen, Mark?
You want me to take share my screen?
Yeah, if you want, if you have slides,
yeah
go for it.
Let me hit the button here.
We met at Think Realty in the turnkey rental space in several different markets, and I specifically was hoping you could come out and talk about what you've been experiencing in the market doing that, the feeling of investors. If I know you work with California investors as well, if they just can't wait to get out of Dodge. And I don't know if you've experienced this, and Kathy could probably speak to this as well, is half the people that, have been building in Florida with the Norris Group has been saying, it's been a good ride. I don't want to be greedy. The other half is the politics are insane. I'm out. So welcome to the show, and I Survive Real Estate. The stage is yours.
All right. Well, thank you, Aaron. I appreciate it. I'm honored to be on the panel here, and congratulations on hitting that $1 million mark. I think that's amazing, and I'm glad to be a part of it. So good job.
Thank you.
So I had a challenge in putting together a presentation here because I created so many slides that I realized this is going to be a 2-hour talk, and then I had to just take a whole bunch of them out. So I might talk a little bit quickly, and I might just kind of go through some of the stuff at a 30,000 foot level, but I think the main points will be highlighted, and you can walk away with some intel on what's going on nationally and with some local markets. But I didn't want to get too deep into the weeds, otherwise it would just drag it on. So based on what you asked me to do to provide some market insights, Aaron, I figured I'd start off with some national trends. And I say national very carefully because we always have to keep in mind that real estate markets are local, and I would argue that they are actually hyper-local. You have to get granular when it comes to real estate markets. So you can't talk about housing from a national perspective all that often. But a couple of things I wanted to touch on here tonight is that home prices have been driven up for quite a while. And then you asked the question, how is that happening? Why is that happening? Well, I can't give you all the reasons, but I can certainly give you some, especially in the recent past. one thing that's been happening is COVID has been driving people to the suburbs, especially from densely populated metropolitan areas. So according to the United States Postal Service, their change of address data, as of, I think, last month, it was 15.9 million people moved during the coronavirus pandemic. That's a lot of people. It's actually top 60 million at this point. And the bulk of these people, or these individuals that are moving, they're really leaving these largely densely populated metropolitan areas like New York and Brooklyn and Chicago, San Francisco. And what they're doing is they're moving out to the suburbs. They're moving to smaller cities in the suburbs. And so that's creating a bit of a mini housing boom in these smaller communities, just further out from the densely populated areas. The states with the biggest losses are actually the states with the biggest cities. You know, they're the ones who are losing the most of these so-called movers. And who are these people? Well, these people are generally college students because they can learn remotely. Now, a lot of these courses are available online, and so they don't actually have to be in the classroom all the time. And other people who are moving out are people who are not tied to the office. They can work remotely and they don't have to report to an office. So they can actually get around and take advantage of being a remote part of the remote workforce. And then if you ask the question, well, why are these people moving? You know, the decision is varied, but two of the main common themes is really one, fear, just avoiding catching this COVID-19. I think there's a lot of false fear being injected into the populace by the mainstream media and you know, the so-called experts that keep changing their opinions on COVID. But regardless of where you sit, you know, with that, avoiding the COVID has been one of the reasons that people are being driven out of the city. And the other are economic reasons. If you don't need to be in the city and spending, you know, a lot on rent in these densely populated areas, why not move to cheaper areas and work from there if you can do it? So another reason is that affordability just became much better in the mid markets, the middle markets, not the low end, not the high end. And this is really due to what you guys were just touching upon a little while ago regarding mortgage rates. You know, due to lower mortgage rates right now, mortgage payments as a percentage of income has fallen, making real estate more affordable from that perspective. So income, you know, as a percentage of income, it actually fell to 15.3% this past July, and that's actually down from a year ago at 16.5%. So even though real estate prices in many markets around the country are inching up, or in some cases actually going up quickly, affordability is actually still there. So we're not pricing people out of the market in most cases. And we just have to remember that people buy based on their monthly payment, not based on the total purchase price. It's an important factor, but people look at what can I afford each and every month. And of course, we have this massive shortage, you know, in supply nationwide, and we're just seeing that pinch pretty much everywhere. Now, I firmly believe, as many people do, that home prices will continue to rise. And the reason for that is because supply is very tight and demand is strong. So right now, baby boomers are choosing to stay put. They're not wanting to sell their house and move out or downsize necessarily. So that limits the amount of supply coming onto the market. Secondly, Freddie Mac has said that between now and the year 2030, we're probably going to have a housing unit shortage of somewhere between 1 to 3, maybe 1 to 4 million. I've done a Google search on this and I'm seeing all kinds of data on this. It's a really, really wide estimate, but regardless of whether it's 1 million, 2, 3, or even on the high end, worst case scenario, 4 million, the problem is it's a major housing shortage. In 2017, we were short 370,000 units nationwide, which is a pretty big problem. And what does this do? Well, this leads to increased rental rates and increased property values because of that lack of supply. You know, people are trying to scoop up these properties. The flip side of that equation is the demand side, and demand is very, very strong. Again, you know, Fannie Mae is saying we need 1.6 million housing units per year just to stay in equilibrium. Well, we haven't supplied 1.6 million housing units since 2007, which is a long time ago if you think about it. To exacerbate this problem, Gen Y, or the millennials, are now starting to slowly move out of the house. And again, these numbers are varied when you look up how many people are in that cohort, you know, that demographic, but it's around 70 million people. So if these 70 million people are starting to move out of the house and looking for rental property, that's going to push rental rates and property values up because it creates yet more demand. And then behind Gen Y is Gen Z, of course, and they just turned 23, I believe it is, the leading edge of that. Again, numbers are all over the place, but that's anywhere from 68 to 82 million more people that are going to get out of the house and start to go and look for a rental unit. So this is just a big, big, big problem. And the last thing I want to touch on is something that is being talked about a little bit more out there, is this shadow demand. Now, we all heard about shadow inventory. It was, the pent-up foreclosures and the pipeline of foreclosures that weren't out on the market yet, but were coming out. It's there, you just don't see it yet. It's just hiding in the shadows, but this is something that's going to come out. And, where are these people coming from? The shadow demand is really these young people that are living at home. And I'm going to show you a slide here in a minute about this, but today it's at a whopping 52%. 52% of young people in this age group of about 19 to 28, I'm close on that. I'm going to show you the slide here in a minute. They're still at home. And so, they're going to get out and start looking for rentals. There's those people who are wanting to get out of the house looking for more space because they need more space in the house. They've now got a home office, or there are more people living in the house. That's going to increase the demand. And then, of course, I'm reading that divorce rates have actually increased during this pandemic because people are just at home with each other all the time. And, that just creates more demand, more need for more housing units, because now instead of a married couple, you've got actually two individuals that are looking for housing. So real quick, I'm going to go through some graphs and slides here because I know I have a limited amount of time. But if you look at this chart, you can see that as of July 2020, 52% of those that are 18 to 29 years old are living with their parents. They're at home. These are U.S. young adults, and they're going to get out at some point, probably sooner than later, but they're going to start trickling into the market, and they're going to start looking for rentals, maybe housing, and that's going to create a problem. It's a good problem, depending on what side of the equation you sit on, but it's a problem nonetheless. And if you look at it, it's actually a high watermark here if you compare it, back to, well, they got 1900 here, but if you just start it, these are actually decades up until the year 2000. Well, actually, it's a decade all the way across. But look at this. It's 52%. That's the highest since the 1900s. Now, I'm going to keep moving along here. Moving trends are pretty interesting, too, because of COVID. I just want you to focus on the top 5 and bottom 5 here. The recipients are mostly cities in Texas. This is where a lot of people have been moving to. The other thing is that when you look at the bottom 5 to 7, where are they moving from? It's these massive metropolitan areas like New York and Brooklyn, Chicago, San Francisco, Los Angeles. What's interesting about New York is the amazing 487% increase in the people that have moved in 2020 compared to last year in 2019. That is a massive change. So when you see that type of exodus, you're going to see the suburbs really start to swell in terms of buyer demand. I wanted to put 2 slides in here about the fastest growing US metros. This is something that I like to follow because not necessarily because I want to be in those markets from an investment perspective, because not all these markets actually make sense financially speaking. The numbers just don't pan out. The ones I highlighted in yellow are actually markets that I've been in or that my company is in at this point in time. But what you're going to see here as I flip back and forth is that a lot of these markets make a lot of financial sense. Many of them are in Texas. Many of them are in Florida. And why is that? Well, one of the main reasons is because these states are benefiting dramatically from population growth, people moving in from more expensive states, from blue states, from colder northern states. So, they're just recipients of this upward pressure in terms of rental demand and buying demand. So I'm not going to read all of these. Of course, you can just see them on the screen here, but you'll notice that a lot of these are Texas, Florida, of course, Phoenix, Mesa, that metropolitan area has really been booming for many, many years. It's just hard to make sense of the numbers there anymore. So it's not a market you will go far with in terms of investment property, which I know was a bit of a spin that Aaron wanted me to take on this. But again, Florida, Jacksonville, Florida, the Tampa area, which is kind of a mixed market. You've got a little bit of everything going on there. The Atlanta metro area has been a perennial market for a long, long time. It's gotten pretty expensive, but it's got a population of about 7+ million people. And so you've got all kinds of things going on there. So now, in addition to the fastest growing US metros, I also wanted to highlight migration rates, because migration to me is critically important, because that's really where the demand is coming from. People need a place to live, whether it's a rental or a household unit. So this first slide is really the top migration states, the states that have been benefiting the most over a 1-year period. And this is really from July 2018 to July 2019. It was the most recent data I could find. Again, Florida leads the pack, over 600 people moving there each and every day on average. It ranks number 1, followed closely by Texas here. But the amount of people moving into these two states really have caused a housing dilemma, especially in the major metro areas like Dallas in Texas, and the major metropolitan areas in Florida, including Southwest Florida, which I'll just touch on very briefly here towards the end. But Arizona and North Carolina, Georgia, these are states that are really all taking advantage of this population growth and the migration patterns that are going on. From a city perspective, the top net migration cities are, again, in those same states. Obviously, it doesn't go without saying, but Phoenix, Arizona is the leader of the pack here, with over 77,000 people moving over that 1-year period. Dallas is second in line, Austin, Atlanta, Georgia, of course. And then you've got Tampa and Florida, Houston, and so on down the line. But I don't think any of these cities should be a surprise to anybody, just because they're in, typically they're in red states or zero income tax states or warm climate states. People just have a tendency to move south. Now, I looked at home builder confidence. The home builder confidence index shows home builders and buyers feeling optimistic and confident about the direction of the housing market. What's interesting about these numbers here is that this is the highest this home builder confidence score has been since 1998. That's a 22-year run. That's pretty incredible. And of course, these feelings of optimism are certainly supported by the wave of these new potential home buyers that are coming along. So I fully expect this confidence index to continue to go up and increase and probably break the 80-point mark. Now, John Burns puts out some great content, and I love his stuff. And he does this monthly Burns Single Family Rent Index, which is always very interesting to take a look at. So among the 63 markets that he tracks here, Kansas City actually came out the strongest in terms of rental growth. And this is as of September. Their year-over-year growth was 7.7%. It was followed by Memphis at 7.5% year over year, and then Tucson at 7.4%. What's interesting as well is that a lot of these will correlate to some of the previous charts I was showing you, with Atlanta, parts of Florida growing quite rapidly, Phoenix, Arizona, of course, Dallas, although Dallas is not as hot as these other markets. But about 7 of these markets are actually experiencing over 5% growth year over year in terms of rent. And that's just the demand, the pressure that's being generated by people moving in rapidly into these markets. So they're benefiting from out-migration from other markets, with the benefit of in-migration into these other markets. Also interesting to note here is that California, if you look at some of these coastal markets, they're really not benefiting. In fact, in some cases, I think rents are actually dropping in the Bay Area. But people are actually moving, and maybe Kathy can speak more to this, but people are actually moving away from the coast, moving inland where rents are cheaper, property values are cheaper because it's more affordable there. And so you're seeing rent growth actually accelerating while it's slowing down or dropping in coastal markets. And same thing for New York and New Jersey and Pittsburgh, places like that. I got this slide last month from Doug Duncan, the chief economist at Fannie Mae, and I just threw it in here just for the sake of highlighting some he gave me a couple of slides, actually. I just wanted to highlight a few things real quick. His estimate for 2021 in terms of real GDP, so inflation adjusted, is 3.5%, which is a beautiful improvement over what we've seen over the last 3 years, especially this year. The unemployment rate is expected to continue to drop. Again, it's hard to look at this on a national level, but from a national perspective, it's expected to drop to 5.8%. When you're looking at inflation and you're looking at the core CPI, it's in lockstep with what the Fed really sets as their target at 2%. So we don't expect that to change either up or down. And then the 10-year Treasury is expected to drop ever so slightly, and that might drop mortgage rates as well. So maybe, Bruce Norris is correct in that we're going to actually hit that 2% mortgage rate that he's been predicting for a few years now. That would be very interesting to see. At least I hope so. All right, I'm just going to quickly highlight a couple of markets here that we've been in for what feels like forever. In fact, Memphis, the first one here, is a market that I've been in for 17 years. Aaron wanted me to just touch on some market insights. So I kind of boiled some key numbers down just to show people that are watching here and listening some opportunities that are out there that you can pursue. Because the reality is that even though rents are going up, prices are going up in many, many markets around the country, I don't want people to feel that they're being priced out of the market or that opportunities don't exist. They actually do exist. It's just a matter of knowing where to find them. Markets change, timing changes, but opportunities persist. So, Memphis, Tennessee is one of the markets that I really like. Now, I tried to find unemployment numbers, and they're all over the place because COVID just seems to keep changing these numbers, and it's really hard to peg it to a specific month of the year. I believe the unemployment rate is lower than 12%, but essentially the job market in Memphis it has an unemployment rate that is dropping. That's, I guess, the key takeaway there, but it has a 10-year growth that's estimated to be a 37% increase in jobs over the next 10 years, which is a great thing because the jobs bring people in. That helps to grow the population, and that growing population needs housing. They need a place to live, and that just adds more to the equation in terms of new household formations. And you being an investor, you're on the right side of that equation to benefit from all that. So the population growth is expected to grow by about grow to 1.4 million people by the year 2025, which is around the corner. It's just about 4 years away. As frames of reference, I wanted to put median price and median rent in here. 86,000 is, I find different numbers on this, but essentially median price is on the low end when you compare it to many other markets around the country, but about 86,000. But the rents relative to that median price is very high, which is why Memphis makes such a great market from a cash flow perspective. And Zillow, for whatever it's worth, whether you believe their numbers or not, or how accurate they may be, they do have a pretty solid forecast in terms of appreciation over the next 12 months of 8.4%. Now, I'm just going to quickly slide through these last two slides because I know that my time is pretty much run out. Indianapolis is kind of the what I'll loosely call a hybrid market. It has been appreciating. It's been a solid market, again, a perennial market for us. Low unemployment, strong 10-year job growth. The population is certainly expected to continue to grow heavily. The Midwest is certainly benefiting from a lot of people moving out from more expensive states. It is a more expensive market, but that's a relative term. 143,000 is a median price, but it is well positioned with the median rents. It's almost, if you follow the 1% rule, which is not a hard and fast rule, it's just a rule of thumb. The numbers really work out there. And again, strong growing market. Now, if you're a person that's looking for strong appreciation potential or you want strong growth markets, Southwest Florida has been great. We're actually covering, I think, 4 or 5 markets in the Southwest Florida region. It's almost all new construction, fortunately or unfortunately, however you want to look at it. But, it's got a good, strong job market. The forecast for the next 10 years is actually above the national U.S. average of 33.5%. We've just been seeing a lot of growth down there. Population continues to grow. People are actually moving in, not just because their parents live there, but because there are jobs. The median price is a little higher than what we typically see for investment properties when you look at it from that perspective, but that's okay. We're talking about new construction, and And what you don't make up on your cash on cash returns on the front end, you typically make up with strong price growth in markets like that. And that pretty much covers it, Aaron. I think I've run out of time. I had one last slide, but since I'm at 23 minutes.
Aaron, can I ask a question?
Sure, of course.
I'm just curious, Marco, what percentage of the purchases involve 1031 exchanges when you're talking about turnkey rentals?
I'm giving you an educated guess right now because my frontline team would know the answer to that. But I would say that about at least 10% of our buyers coming in right now are doing 1031 exchanges. And of those, most of those are coming from California and the upper Northeast.
Okay. And what's your reaction to a nothing down loan program?
Oh, he's calling people out now.
I actually really like the idea, provided that they are very well qualified borrowers.
Yeah, like a VA.
They need to prove that they can afford it and pay it, and their sustainability in being able to make the payments.
Completely agree.
A $15,000 tax credit if Biden becomes president. What's the?
That's the nothing down loan.
Correct. For a lot of these markets that Marco was just covering. Yeah.
Trouble is it costs 15 grand.
Not from the, yeah. Okay.
Well, the trend has been mortgage rates dropping. And when I bought your program with the 2% mortgage rate, years ago, I thought that was a bit of a stretch, but now I completely see it.
All right.
Thank God. Unfortunately, the 40 trillion is going to happen too.
Yeah, the other part of the equation. All right. Thank you, Marco.
Thank you for tuning in to I Survive Real Estate 2020. To watch the full video in its entirety or to learn more about speakers and sponsors, please go to isurviverealestate.com and be sure to tune in next week for more I Survive Real Estate 2020. Thank you.